When you picture a small business owner during tax season, what's the first image that comes to mind? For most people, it's the cliche of someone showing up with a shoebox full of crumpled receipts. Gas station slips, coffee shop purchases, vendor invoices, all dumped into one messy pile. Somewhere in there, theoretically, are the business expenses that matter. It's an image we laugh at, but here's the thing, it's not just a myth. It's the reality for a lot of entrepreneurs. And if that's you, you're not alone. The shoebox method has been passed down like folklore. Keep every receipt, dump it in a box, and deal with it later. The problem is, later usually comes when it's too late, when you're already stressed, staring at deadlines, and wondering what half of those charges even were. Let's be honest, a shoebox full of paper isn't a system. It's a headache waiting to happen. On the surface, hoarding receipts seems safe. After all, you're not throwing anything away. But here's what actually happens. Receipts fade. Thermal paper, the kind you get from gas stations, restaurants, and retail stores, starts to fade within weeks. By tax season, you might be holding a blank slip of paper. Receipts get lost. One coffee spill, one move, one oops, the dog ate it, and your proof is gone. Receipts without context are useless. A $47 Home Depot slip doesn't prove what you bought or whether it was business related. Without notes, it's just paper. In other words, the shoebox gives you clutter, not clarity. Now let's put on the IRS lens for a second. As a former agent, I can tell you, receipts matter. They're one of the most straightforward ways to prove an expense. But here's the catch. Just having them isn't enough. The IRS doesn't care that you saved the paper. They care that it clearly supports the expense as ordinary and necessary for your business. That means they want to see the date, the vendor, the amount, the business purpose. A shoebox full of random paper slips often fails this test. That's why organization matters. Beyond IRS rules, there's the mental weight of the shoebox. Every time you see it sitting in the corner of your office, you feel that little knot of stress. I'll deal with that later. But later keeps getting pushed and the pile grows. Come tax time, later explodes into hours of sorting, guessing, and hoping that you don't miss anything. That's when panic sets in. What if instead of carrying that stress all year, you had a system that made receipts painless? That's what this episode is about. Turning the shoebox myth into a smarter, simpler, stress-free reality. Some of you might be thinking, do I even need receipts anymore? Everything shows up on my bank statement. Good question. The answer is yes. You still need receipts. Here's why. Bank statements aren't proof. They show that money left your account, but not what you bought. Was that $85 at Lowe's for business supplies or home gardening? Without a receipt, you can't prove it. Receipts show detail. They list the item, the vendor, and often taxes. That detail matters if you're ever audited. Receipts keep you honest. They force you to separate personal and business spending. Think of receipts as your receipts plus context. A bank charge is just a number. A receipt tells the story behind it. Here's the shift I want you to make. Stop seeing receipts as clutter. Start seeing them as protection. They're not scraps of paper you have to hang on to just in case. They're the paper, or digital file, that backs up your right to claim an expense. They're your insurance policy against questions, audits, or just your own forgetfulness. When you flip that mindset, receipts stop being a pile of stress and start being a part of a clean, simple system. So here's what we're going to do today. We're going to take receipts from shoebox panic to organized clarity. We'll talk about paper versus digital and why the IRS is fine with digital storage. We'll walk through easy hacks to make digital receipt storage a no-brainer. We'll break down what counts as ordinary and necessary, so you're not saving junk. And we'll build a simple expense log that ties it all together. By the end, you won't just know why the shoebox method is outdated, you'll know how to replace it with a system that works month after month, year after year. Because receipts shouldn't be a punchline, they should be proof. When it comes to receipts, small business owners usually fall into one of two camps. Camp 1 is the paper hoarders, the folks with the folders, shoe boxes, glove compartments, and desk drawers stuffed full of little slips. Camp 2 is the digital first crowd, the ones who snap a quick photo on their phone and toss the paper immediately. So which one is right? Let's break it down. There's something about holding a paper receipt in your hand that feels real, tangible. You can touch it, file it, wave it in front of an IRS agent if you need to. That sense of safety is why many small business owners still default to paper. But paper comes with major drawbacks. Fading ink. Most retail receipts are printed on thermal paper. Within weeks, the ink starts to fade. By tax season, your $47 Home Depot receipt may be a blank strip of paper. They're easy to lose. Paper is physical. That means it can get lost, spilled on, crumpled, or shredded by accident. Hard to organize. Even if you use folders, you still end up digging when you need something. In short, paper feels safe, but rarely stays safe. Digital receipts solve nearly all of paper's problems. They don't fade. A scanned or photographed receipt will look the same 5 years from now. They're searchable. You can type Home Depot into your drive and instantly find every receipt. Try doing that with a shoebox. They're duplicable. One spilled coffee won't ruin your records because you can back them up. They're IRS approved. The IRS allows digital copies of receipts as long as they're clear and legible. The last point is big. There's no legal requirement to keep paper. As long as you can produce a digital copy that shows the date, vendor, amount, and details, you're covered. This is where the IRS lens matters. In my years as a revenue agent, I saw both paper and digital records. Here's the truth. The IRS doesn't care how you keep your receipts, only that you can produce them when asked. A shoebox of paper receipts? Acceptable, if legible. A folder of PDFs in Google Drive? Acceptable, if legible, and can be provided on a thumb drive or uploaded to an IRS document portal. And a scanned image from an app? Acceptable, if legible, and again, can be provided on a thumb drive or uploaded to an IRS document portal. The key is clarity and consistency. If you hand over 200 blurry photos that don't show dates or vendors, that's a problem. If you hand over a neat folder with labeled PDFs, that's gold. Some business owners prefer a hybrid approach. Keep paper receipts short term, a month or two, scan or photograph them into a digital system, and then shred or recycle the paper once you've confirmed the digital copy is safe. That gives you the peace of mind of having something in hand and the security of long-term digital storage. Now let's see how this plays out in the real world. As an Etsy seller, you might buy supplies at Michael's. The receipt is thermal paper. By the time you file taxes, the ink is gone. If you snapped a photo on your phone the day you bought it and saved it to a folder called Supplies 2025, you're protected. As a food vendor, you buy bulk food at Restaurant Depot. The receipt is 3 feet long. Are you really going to keep that in a folder for 7 years? Scan it, save it, shred it, done. And as a tradesperson, you pick lumber up at the lumber yard. The cashier emails your receipt automatically. Perfect. Drop it into your digital folder and skip the paper entirely. These examples show you how everyday purchases become painless when you lean digital. Now let's clear up some common myths I hear all the time. The IRS won't accept digital. False. They've accepted digital copies for years as long as they're legible. Bank statements are enough. Also false. A bank statement shows that money left, not what you bought. You need the itemized receipt. And I have to keep the original paper. False. If you digitize it clearly, you can toss the paper. Don't let myths keep you stuck in the shoebox era. Let's say you've got years of paper receipts and the thought of scanning them all makes you want to cry. Here's how to handle it. Start fresh today. Don't get stuck trying to scan back everything from 2019. Start by digitizing every new receipt from now on. Set aside the past. If you want, scan old high-dollar receipts or ones tied to assets like tools or equipment. The rest, file them in a folder labeled 2024 Receipts Paper. And transition over time. Each month, move a handful of older paper receipts into digital storage. Slow and steady is fine. The goal isn't perfection. The goal is progress. And one final point. Digital is only as good as your backup. Use cloud storage, whether it be Google Drive, Dropbox, OneDrive. Keep a local backup on an external hard drive once or twice a year. And name your files clearly. For example, year, month, date, underscore, vendor, underscore, amount, underscore, category. That way, even if your computer dies, your receipts live on. Here's the takeaway. Paper receipts are fragile. Digital receipts are secure, searchable, and IRS approved. A blended system can ease the transition. The shoebox method is out. The cloud folder is in. And once you make the switch, you'll wonder why you ever clung to fading paper in the first place. Now that we've established digital receipts are not only acceptable, but preferable, let's talk about how to actually do it. The phrase digital storage system might sound intimidating, like you need a degree in IT or expensive software. You don't. With a few simple hacks, you can build a foolproof receipt system that works for your business no matter how small or how non techy you feel. Hack number 1, use the cloud you already have. Most of us already have access to a cloud storage service and don't even realize it. Google Drive. It's free with any Gmail account. You get 15 gigabytes of storage right out of the gate. Dropbox. Free basic accounts come with 2 gigabytes, plenty for scanned receipts. Or OneDrive. Comes with Microsoft accounts. If you already use Word or Excel, you probably have it. You don't need to buy fancy software. Just use the service you already have and stick with it. Consistency matters more than the platform. Hack number 2, create a simple folder system. The biggest mistake people make is dumping receipts into a single folder. That's just a digital shoebox. Instead, structure your folders so you can find what you need fast. Here's one setup I recommend. Have a main folder titled Business Receipt. Have subfolders with the years, for example, 2025, 2024, 2023, and so on. And inside those year folders, have folders for the months, so January, February, and so on. And if you prefer categories instead of months, that can work too. Your main folder would be business receipts, and then inside you would have subfolders of supplies, meals, travel, subscriptions, whatever other expenses you may have. Which system should you choose? It depends on how your brain works. If you think by time, go monthly. If you think by type, go category. Hack number 3 is name your files like a pro. A receipt saved as image_3948 isn't helpful. You need a clear searchable name. Use this formula: date underscore vendor underscore amount underscore purpose. For example, 2025-03-14 underscore Home Depot underscore 248 decimal 93 underscore supplies dot PDF. This way, even if you forget which folder it's in, you can just search Home Depot or supplies and it pops right up. Hack number 4, use your phone as a scanner. You don't need a bulky scanner anymore. Your phone is plenty. iPhone. The Notes app has a built-in scanner. Open a note, click the camera icon, and scan documents. Android. Google Drive also has a scan feature. Tap the plus and scan. An app such as Cam Scanner, Adobe Scan, or Genius Scan if you want extras like auto cropping. Snap, save, done. The key is to scan receipts right away, ideally the same day you make the purchase. Hack number 5, automate with email receipts. Many vendors now email receipts automatically. Don't ignore them. Create a system to funnel them into storage. Gmail filters. Create a rule so any email with receipt in the subject goes to a receipts folder. Forwarding. Forward digital receipts to yourself with a clear subject line like 2025-02-20 Lowe's $142 supplies. Save as PDF. Open the email receipt, click print, and click save as PDF, and then drop it into your receipts folder. This hack alone can cut your paper pile in half. Hack number 6, apps that do the heavy lifting. If you want to go one step further, there are apps that not only scan but also organize your receipts. Expensify. You snap a photo and it auto-categorizes. Shoebox. Yes, ironically named. You can even mail them your paper receipts to digitize. And Wave Receipts. It's free, simple, and integrates with bookkeeping. But remember, tools are only as good as your consistency. Don't sign up for 5 apps and abandon them. Pick one and commit. Hack number 7, pair receipts with your books. The real magic happens when you connect receipts directly to your bookkeeping. In Excel, add a column with a file name or link. Example 2025-03-14 underscore Home Depot underscore 248.93 underscore supplies. That way your expense log directly ties to the receipt. In QuickBooks, upload the receipt image and attach it to the transaction. Come tax time, everything is linked. This one step makes your records nearly bulletproof. Hack number 8, dummy proof it. Not tech savvy? Keep it stupid simple. Create one folder called Receipts 2025. Every time you buy something, snap a photo. Drop the photo in the folder. That's it. Is it perfect? No, but it's miles better than a shoebox. Hack number 9, schedule a receipt dump. Set aside one day a month, maybe the first Sunday, to clean up your receipts. Scan any paper you still have, move photos into your folders, and back up to the cloud. It doesn't have to take more than 30 minutes if you keep up with it. Hack number 10, back up, back up, back up. I can't stress this enough. Digital systems are only safe if they're backed up. Cloud storage is step one. External hard drive once or twice a year is step two. And if you want to be extra safe, use two different clouds, for example, Google and Dropbox. That way, even if one fails, you've still got your records. Now let's make this real. You're an Etsy seller and you're buying $30 in ribbon and $45 in shipping labels. Snap photos at checkout. Name them 2024-04-02 underscore Joanne underscore 30 underscore supplies and 2025-04-02 underscore Amazon underscore 45 underscore shipping, dropping them into the April folder, and you're done. As a food vendor, you stock up at Costco for $322. Use Google Drive Scan and save as 2025-04-15 underscore Costco underscore 322 underscore food. Drag to April, shred the paper. And as a tradesperson, you buy $500 in tools at Lowe's. The store emails you the receipt. Save the PDF, drop it into the tools folder, and attach it to the expense in QuickBooks. Now you're airtight. The biggest hack isn't tech, it's mindset. Stop treating receipts like clutter. Treat them like assets. Each one is proof that reduces risk. Each one is a piece of the puzzle that makes tax season simple. Each one, stored properly, is one less thing to stress about. When you start seeing receipts as protection instead of paper, these hacks stop feeling like chores and start feeling like insurance. So to wrap up this section, you don't need a complicated app. You don't even need to reinvent the wheel. All you need is a cloud folder, a simple naming system, and a habit of scanning or saving it right away. That's it. That's your digital receipt system. And once you build it, you'll never go back to the shoebox. We've talked about how to store receipts, but let's step back and ask the bigger question. Which receipts actually matter? If you've ever wondered, do I really need to save this, or can I write this off? Then you've already bumped into the IRS's favorite phrase, ordinary and necessary. This phrase is the gatekeeper between what counts as a deductible expense and what doesn't. And while it sounds like legal jargon, I'll translate it into plain English. How the IRS puts it, an ordinary expense is one that's common and accepted in your trade of business. A necessary expense is one that's helpful and appropriate for your business. That's it. Not scary, not mysterious, just two simple tests. Is this a normal expense for someone in my line of work? Is it helpful or appropriate for running my business? If the answer to both is yes, you've got an ordinary and necessary expense. Let's make it concrete with examples for the groups that Zero Fluff Books focuses on. As an Etsy seller, an ordinary expense may be buying shipping labels, packaging, craft supplies, or Etsy fees. Every seller does this. A necessary expense may be paying for Canva or Photoshop to create product images. Not every seller does, but it's clearly helpful. Would a $600 espresso machine for your home kitchen be deductible? Probably not, unless you're selling coffee beans on Etsy. As a food vendor, an ordinary expense would be buying meat, produce, cooking fuel, napkins, serving containers, and a necessary expense would be renting a portable hand washing station for your food truck. It's appropriate for your business. Would a gym membership be deductible? No, it's personal. It's not connected to serving food. And as a tradesperson, an ordinary expense would be buying lumber, nails, paint, safety gear, and small tools. A necessary expense would be paying for liability insurance or licensing fees. Would remodeling your personal bathroom count? No, personal use doesn't pass the test. Here's where business owners get tripped up: the gray area where expenses overlap with personal use. For example, a cell phone. If you use your phone 70% for your business and 30% for personal, you can only deduct the business portion. The IRS expects you to be reasonable, not to claim the whole bill if you're also scrolling TikTok on it. Example 2 is your vehicle. If you use your truck for hauling materials during the week and taking the kids to soccer on Saturday, you track mileage. Business miles are deductible. Personal miles aren't. And example 3, the home office. If you have a space in your home used exclusively and regularly for business, like a spare bedroom turned Etsy shipping station, you may deduct that portion. But the corner of your dining table doesn't pass the test. The rule of thumb: if you'd spend the money even without the business, it's likely personal. If you only spend it because of the business, it's probably deductible. Receipts aren't just proof that you spent money. They're proof that your expenses meet the ordinary and necessary test. A $300 Amazon charge on a bank statement could be anything: groceries, toys, supplies. The receipt clarifies that it was $300 in packing tape and boxes. A $90 restaurant charge could be dinner with your family, or a legitimate business meal with a client. The receipt, plus a quick note, such as lunch with supplier, makes it ordinary and necessary. Without receipts, you're left arguing your case with no evidence. With receipts, you've got backup. During my IRS years, I can tell you this: the agents aren't looking to disallow everything. They're looking for proof that what you claimed is ordinary and necessary. When you provide clear receipts tied to your business activity, you make the agent's job easy and your audit short. When you don't, you invite questions, delays, and stress. Think of receipts as your defense file. They're not about paranoia, they're about protection. And some common missteps to avoid. Mistake number one is saving everything. Some people overcorrect and save every single receipt, from personal groceries to birthday presents, thinking, I'll sort it out later. That just creates clutter. Focus on business-related expenses. Mistake number two is forgetting notes. A restaurant receipt without a note is risky. A simple client meeting RE project makes it clear. Context matters. Mistake number three is double dipping. You can't claim the same expense twice. If you deduct mileage for your car, you can't also deduct gas receipts. Pick one method. And mistake number four, mixing personal and business. Buying groceries and office supplies on the same Target run? Split the receipt. Circle the business items, scan and store only those. Now, different industries do have different quirks, and let's touch on a few. For Etsy sellers, craft books or training courses are likely deductible. Your Netflix subscription is not deductible, unless you sell items tied directly to Netflix, which is highly unlikely. For food vendors, taste testing ingredients for new recipes? Deductible. Your weekly family groceries? Not deductible, even if some of the same items show up in your business menu. And for tradespeople, safety boots used only for job sites are deductible. Sneakers you wear everywhere? That's personal. The key? Tie every expense back to your business activity. If it directly supports your work, it's ordinary and necessary. When in doubt, ask yourself two questions. One, would another business like mine see this expense as normal? And two, did I spend this money because of my business, not just because of personal life? If yes, save the receipt. If no, skip it. To strengthen your case, don't just save receipts. Organize them with context. Meals. Note who you met with and why. Supplies. Note the project or product they were for. And travel. Note the business purpose of the trip. This turns receipts into airtight proof of ordinary and necessary. So to wrap up this section, ordinary and necessary doesn't have to be confusing. It simply means ordinary is common for your business and necessary is helpful for your business. Receipts are your way of proving both. So the next time you're standing at checkout wondering, do I need to save this? Run it through the filter. If it passes, snap it, save it, and file it away. Your future self and your peace of mind will thank you. We've tackled the shoebox myth, the paper versus digital debate, and what actually qualifies as an expense. Now let's bring it all together with the final piece of the puzzle, the expense log. If receipts are your evidence, the expense log is your index. It's the roadmap that tells you what you spent, when you spent it, who you paid, and why. And the good news, you don't need to be an accountant or even particularly tech savvy to build one. You might be thinking, if I have receipts and bank statements, why bother with a log? Good question. Here's why. It connects the dots. Your receipts are proof, but your log ties them to categories that make sense. It speeds up tax time. When your expenses are summarized in a log, filing or handing things off to your tax bro is 10 times faster. It keeps you honest. Writing things down forces you to notice patterns, like too many miscellaneous purchases. And it reduces panic. Instead of scrambling to remember what that $74 charge was for, your log spells it out. Think of it like cooking. The receipts are your ingredients, but the expense log is your recipe. Without it, you've got a pile of stuff and no clear meal. So at a minimum, every expense log should include these columns: date, when the expense happened; vendor, who you paid; amount, how much you paid; category, supplies, meals, travel, subscriptions, etc. Business purpose, a few words explaining why you purchased it. And a receipt file, name, or link. It's optional, but it's powerful. So an example row could be date 2025-03-14. Vendor, Home Depot, amount $248.93. Category supplies, business purpose is lumber for client jobs, and your receipt link is linked back to that file that you created earlier with your receipt of 2025-03-14 underscore Home Depot underscore 248.93 underscore supplies. With just these fields, you've got a crystal clear record that ties directly to receipts and categories. You have two main options here. You can use a spreadsheet, such as Excel or Google Sheets. The pros are they're free, simple, and accessible from anywhere. The cons are manual entry and no automation. Then they're best for small businesses with fewer than 200 transactions a month. Accounting software, QuickBooks, Wave, Xero. The pros are bank feeds, receipt upload, and automatic reports. The cons are the subscription cost and the learning curve. They're best for businesses with higher volume or those who want automation. For most Etsy seller, food vendors, and tradespeople under 200 transactions a month, Excel is more than enough. Here's a simple setup you can build in under 30 minutes in Excel. Open a blank spreadsheet. Create headers, date, vendor, amount, category, business purpose, receipt link. Format the amount column as currency. Create a drop-down list for category. Example categories could be supplies, meals, travel, subscription, marketing, insurance, miscellaneous. This makes your entries consistent and avoids typos like supplies with a Z. And then add formulas for totals. At the bottom, use equal sum with parentheses to total amounts by category or month. Common mistakes to avoid. Mistake number 1, skipping small expenses. Many owners don't bother logging $5 or $10 charges, but those add up. 50 small charges equals $500. Track them all. Mistake number 2, lumping everything as miscellaneous. The IRS hates this. Break expenses into clear categories. Miscellaneous should be rare. Mistake number 3, recording infrequently. Waiting 3 months to log expenses is a disaster. You'll forget details, lose receipts, and dread the catch up. Weekly or monthly logging is key. Mistake number 4, no notes. Amazon $125 doesn't tell you much. Amazon $125 packing tape and bubble wrap is clear. Always add notes. Here's where your digital receipt system meets your log. Save your receipt as a PDF with a date, vendor, and amount. Enter that info in your log. Copy-paste the file name or link into the receipt link column. Now every log has a receipt attached, and that's the audit-ready combo. If Excel feels like too much, software like QuickBooks Online or Wave can automate this. The bank feed pulls in transactions automatically. You upload or email receipts and they attach to expenses, and reports summarize categories for you. But remember, automation isn't magic. You still have to review categories and make sure transactions are correct. Here's what a simple expense log gives you. Tax time relief. Your totals by category are ready to plug into your return. Audit protection. You've got receipts linked to every entry. Business insight. You can see trends like how much you're spending on shipping or supplies. And peace of mind. You don't have to wonder, what was that charge? It's a small habit with a massive payoff. And like reconciliation, the expense log only works if you do it regularly. Here's a rhythm. Weekly, log expenses from the past 7 days. Monthly, review your totals by category. Quarterly, compare spending to income. Are you profitable? And at year end, hand the clean log to your tax pro or file yourself with confidence. The key is consistency. 5 minutes a week beats 5 hours of catch up. So to wrap up this section, an expense log isn't complicated. It's just date, vendor, amount, category, business purpose, and possibly a receipt link. That's it. That's the entire system. Simple, clear, and powerful. The myth is that you need a shoebox. The reality is you need a log. And once you build it, receipts stop being clutter and start being clarity. We started this episode with the image of a shoebox full of receipts, crumpled paper slips, fading ink, and a pile of stress waiting to explode at tax time. Hopefully by now, you see why that old myth doesn't serve you anymore. Receipts aren't clutter, they're proof. And when you organize them, they become one of the most powerful tools for running a business with confidence. Here's what we covered today. The shoebox myth. Dumping paper in a pile isn't a system, it's chaos. Paper first digital. Paper fades, gets lost, and clutters your space. Digital receipts are secure, searchable, and IRS approved. Storage hacks, cloud folders, clear naming system, phone scanners, and monthly check-ins make receipts painless. Ordinary and necessary. Expenses must be common for your business and helpful for your business. Receipts prove both. And an expense log, a simple log that connects your receipts to categories, totals, and notes, turning proof into insight. When you step back, the message is clear. Receipts don't have to be scary, they just need a system. Here's your practical takeaway. Pick a system. Decide today, paper, digital, or hybrid. Start simple. Create a Receipts 2025 folder. Save your next receipt with a date, vendor, and amount in the file name. And build a log. In Excel or QuickBooks, set up a table with date, vendor, amount, category, and business purpose. And make it a routine. Spend 5 to 10 minutes each week updating your log and dropping receipts into your folder. That's it. No shoebox, no panic, no overwhelm. If you like to be hands-on, this is a system you can build today with tools you already have. Excel or Google Sheets, your phone's camera, that's all you need. But if you're staring at piles of receipts from years past thinking, there's no way I can catch up, take a deep breath. You don't have to fix it all overnight. Start fresh with the next receipt. Build the habit going forward. And if the backlog feels impossible, that's exactly where Zero Fluff Books comes in. Cleanup isn't scary when you've got help. We organize the mess, recreate logs, and turn your shoebox into an audit-ready system. The payoff of ditching the shoebox is huge. You gain clarity because you know where your money went. You gain confidence because you can defend your deductions. You gain control because you're running your business with intention, not reaction. And you gain peace of mind because there's no more late night worrying over missing proof. Receipts may look like scraps of paper, but they're really building blocks. They tell the story of your business, they prove your expenses are ordinary and necessary, and when you log them, they give you insight into how to run smarter. So don't settle for the shoebox myth. Build your system, keep it simple, keep it consistent, because receipts aren't clutter, they're clarity. Clean books, less stress, zero fluff.